Krishnan, the co-CIO and head equity of Aditya Birla Sun Life Asset Management Company. So, Phil, firstly, to start off with, the last 1.5 months have been quite volatile. We have seen a 3,000 points fall in the market, that is the benchmark. From there, we did see one third of the losses being recovered. So, how are you reading into the market, and do you expect the upward momentum that we have seen for the past few days to continue for the market from here on, or there could be some more downside, or market would remain sideways from here on? How are you reading into the market currently?
Good afternoon. I think this has been a welcome development, primarily because market had continued uh, to go up from a period from say May to September, despite poor quarterly numbers, despite an electoral verdict which wasn't really the best of outcomes from an investor perception point of view, as well as capital gains taxes, the changes made there. So in some sense, this 10% kind of a cool off uh, removed some of those excesses that have happened, and now we are in a far better zone. While indices have fallen maybe about 10%, there are multiple stocks which have fallen maybe 20-30%. And to our mind, I think there do appear a lot more buying opportunities from a 3 to 5 year perspective at today's entry valuations in many sectors and many stocks.
So, if you could specify which are those sectors where stocks have corrected and currently appear as a value buy at this moment?
Sure. So we think that there are three sectors which we classify as dark horse sectors, sectors which haven't done really well from a 3 to 5 year perspective, where ownership levels in the street are very low, and where there is a potential chance for a revival over the course of the next 3 years or so. Topping the list would be cement sector. Then you've got the metal sector and the consumer durable sector. These are the spaces where we think that any correction we would want to further increase our allocation into these sectors. Sectors which have had reasonably strong business momentum, including sectors like auto ancillaries, capital goods and infrastructure, IT, pharma. These are the sectors which were displaying reasonable amount of business momentum, and therefore a fall of say 10, 15, 20%, we would want to further increase our allocations out here. So these would be the areas where we would have further bolstered our exposure during the current fall, and we would look for additions to these sectors in case we see further falls from here as well.
All right. Hi, Harish. Very good afternoon. This is Shrishti also joining in. Just wanted to get a sense that at this point in time, how should one place the bet within the mid and small end of the market as well as the large cap space? Because what we are seeing is that, yes, indeed, the broader markets have outperformed on a YTD basis as well. But given the recent correction, do you believe that now is the time to go ahead and bet more on the large cap space versus the broader end of the market?
So, Srishti, if you look at the year-to-date performances, clearly the broader indices or the broader market segments have done better than, say, the large caps. But the extent of outperformance is not very large. The same time frame last year, if you were to think about it, the gaps used to be 15, 20, 25% between various categories like small cap and large cap funds. This year, we are seeing gaps which are more like the 5-7% or 3-5% from a category point of view, right? So the second aspect is, yes, large caps have fallen more primarily because FIIs have been selling, and FIIs have traditionally held on to much more of large caps, and therefore they bore the brunt of the selling. But the point really is that we don't see any big material difference in terms of earnings growth, be it in large, mid, and small cap. So, in the absence of any significant difference in earnings growth, we think that one is better off being in large caps and to a certain extent into mid caps than being into small and micro caps at this point of time. So, and in essence, the extra return that one has made up, possibly for calendar year till date, doesn't take into account the risk that when liquidity dries up quite meaningfully in the micro cap segment. So therefore, our preference would be for the large and mid cap space.
Right. And when it comes to banking names, how are you reading into that, given the fact that valuations continue to remain on the cheaper side, both for private and the PSU banks, and also earnings are expected to pick up now anytime soon for this sector. So how are you positioning banking names in your portfolio?
Right. So, if we were to circle back, say about 18 months back, when the banking sector earnings were on the top gear, you had everything going right for banks. We had actually gone on a reasonably large underweight stance as far as banking is concerned. Um, at that point of time, we believe that earnings were possibly getting into the super normal stage, due to which even as banks kept delivering record earnings, their stock prices didn't kind of react. Over the course of the last 3 to 6 months, a lot has changed. The regulator has tightened the screws quite significantly. Credit growth has come off quite meaningfully. You also have net interest margins, which were at very elevated levels, normalizing, and you've got credit cost starting to move up. In some sense, what we were saying is that 18 months ago, each of these three levers were at the best of health. Today, they are all coming back into normalcy. And therefore, we think that now is the time wherein we have cut our underweights and we've gone close to neutral as far as banks are concerned. And we would actually be welcoming any further cuts in earnings as far as the banking space is concerned. So therefore, we would want to be increasing exposure into banking space, especially into the private banking space. There would be opportunities coming into the insurance space, etc., where the near-term earnings might be a bit soft, but we think that the franchise value of many of these companies is excellent and therefore provides a very good opportunity to increase our allocations.
All right, Harish, with this, we did note that the recent correction does offer wells and give you some more opportunity to increase your exposure. But Harish, if you can also, and if you would like to highlight some of the risk factors for the markets, and especially the Indian players in the times ahead, or do you believe that we are just out of the woods and the market, the flavor of the bulls should be back in the market soon?
So generally, when as they say, right, when everybody's focus is on earnings and micro, I think macro is where things can surprise. And a lot has gone right as far as India macro is concerned over the course of the last 3 4 years, and therefore all investors' attention kept focusing on the micro, and rightfully so. I think we need to be watchful of macro developments, especially when it comes to the geopolitical side. We've got two large economies, the US and China, post the Trump presidency inauguration. I think it's very important that we need to see how the tariff regime change kind of pans off. The second thing is we've seen an exceptional dollar strengthening. That is again something that we need to be watchful of as to how other currencies start. Is there a race to competitive devaluation? This is something that I think Indian currency needs to be very watchful of. While today everything is looking all good, I think one needs to have this in the back of their mind before aggressively committing capital. So I would just say that in an environment where most people are not talking about macro, I think that is where the possible risk can come through, especially when it comes to the currency side.
Thank you, Harish, for joining us and for giving us your perspective about the markets. With that, let's.
If you like this video, then like, share and subscribe to ET Now.